Unit 2, The Economy, Lecture 3, Economic Objectives and Economic Indicators, Part B. Now, the most important tools of monetary policy include reserve requirements, open market operations, and the bank or discount rate policy. So the central bank requires banks to hold a specified proportion or percentage of their depositors' funds as cash reserves. Now, in order to influence the money supply, and by extension, the amount of credit that banks can give to their borrowers, the reserve requirement can be changed directly by the central bank. So by increasing the reserve requirement, that is by increasing the percentage of depositors' funds that banks need to hold, that reduces the amount of money in the economy and reduces the amount of credit that banks can extend. Obviously, the opposite is true if reserve requirements are decreased. Open market operations involves the buying and selling of government and other securities by the central bank to influence the supply of money in the economy and by extension interest rates and the volume of credit. Now, this is achieved in the following way. Expansionary monetary policy involves increasing the supply of money. This is done by the central bank buying securities. This puts money into the economy, increases the supply of money, decreases interest rates, which is the cost of money, and stimulates credit extension and growth because credit is now cheaper. Obviously, contractionary monetary policy will be the reduction of the money supply in the economy, and this is achieved through the sale of securities, and this results in an increase in interest rates and a reduction in credit extension. Now, the final monetary policy tool is the bank or discount rate policy. Now, the discount rate is the rate at which banks borrow from the central bank. In South Africa, we call this the repurchase or repo rate. So, banks borrow from the central bank primarily to meet temporary shortfalls of reserves. So, by varying the repo rate in South Africa, the Reserve Bank can affect market interest rates. So, by increasing the repo rate, what it means is that the cost of borrowing from the central bank goes up, and banks will tend to build up reserves, and this should have a negative impact on credit extension and interest rates. The opposite is true if the central bank reduces the repo rate of the Reserve Bank. So, an accommodative or expansionary monetary policy reduces the repo rate in South Africa, and a restrictive or contractionary monetary policy is when the repo rate is increased. As mentioned previously, the South African Reserve Bank is the central bank of South Africa. So here in South Africa, the South African Reserve Bank influences the overall lending policies of banks and the demand for money and the amount of credit in the economy indirectly through changes in banks' liquidity and interest rates in the money market. And the primary goal of the Reserve Bank is to achieve and maintain price stability. Now, even though the tools of monetary policy involve influencing money supply and interest rates, the indicator that governments target after consultation with the Reserve Bank is actually inflation. So South Africa uses inflation targeting to manage economic activity when using monetary policy. For us here in South Africa, we target a band of inflation, and the band is 3% to 6%. Now, in addition to fiscal policy and monetary policy, there are also direct controls that can be used to influence economic activity. Some of those direct controls include prices and income policy. Here, there is an attempt to control inflationary pressures by restraining price and wage increases. There's also import controls, and here, quotas and tariffs on the importation of products into a country can be used to correct the balance of payment deficits.